Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. We can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning. Well, guys, today is the day to be on your toes because we've got currency intervention in the market. I kind of thought that, I remember the end of last week I was going, well, I think that currency intervention after the FOMC could be a thing. I didn't expect it to happen literally the next day. So, yeah, now this gets complicated because generally speaking, people think that the currency intervention works at first, but then like 2 weeks later we fall down. So interest rates are probably in for a wild ride here, but let's go to the charts and I'll show you what's been going on. The Japanese yen having a huge pop here this morning as the intervention comes in. So overnight, the treasuries were moving to the downside and then flipped up to move with the Japanese yen. Meanwhile, S&P 500, big dip yesterday. They're trying to recover. I wouldn't be surprised if we see a bit of a rally today. So my thinking here is that this is the first time all year, really, during the first time during this whole ordeal that I felt like the market was on par with the Federal Reserve now. Like they understand what the expectations are. Everything's set. We're all in line with what we should be to be fighting inflation now. So that could mean that we might be getting peak rates right now. We come over here to oil. Oil also got hit yesterday and recovering overnight. I think one of the key thing here though is gold and silver. Well, you can't really see it too much, but we did get gold took a pretty good jump up at the end of yesterday and is now having a jump up here with the Bank of Japan intervention. So the expectation of currency intervention may be why we saw those jumps in gold and silver. Copper is it's still kind of middling, but we might be getting something here in copper. And coming over to Bitcoin. Bitcoin taking a bit of a plunge, brief new weekly low, but recovering it again. Somebody is fighting that one real hard. And then we got the dollar. So with Japanese yen rising, that means that the dollar should be falling. But the euro back below parity. You know what? We should also point out the British pound is getting not so hot. Although they look like their things are improving for them. They did a 50 basis point hike. So the currency picture is going to could make today difficult. Well, it might make it easy, but I'm leaning towards the difficult side just because I've never traded in such an environment. I'm looking at it right now. They've pulled back and are settling. There's a really wide spread in the micros, and I'm like, I can't trade this. But maybe we get some more information. Maybe we get a pickup in one direction. I think that we got to be on the lookout for another run in the Japanese yen pushing us up. All right, let's see here. I need to blow my nose here. Well, I'm noticing I couldn't see it in the 30-minute chart, but I am seeing now on my 5-minute chart natural gas kind of inching lower. Gonna keep that chart on. Corn though, 6J up 2.38% today. I think that could probably, because the numbers that I was reading, like on Zero Hedge and stuff, were like 5%. So does that mean they didn't reach those yet? The amount that it tends to go. Hmm. Let's just come over here and see if there's any more. Serbian president warns of great conflict within 2 months. Yentervention, yes, that's what we should call it. Yentervention. The squeeze on global liquidity has barely begun. That's a new story they've got. Yeah, I'm not. Well, let's see what they do here. 24.5, but it looks to me like the treasuries have kind of gone dead. I was thinking that we would get 3.56, but morning, Tommy. How are you doing? Good. Don't let the cacophony of central bank hike announcements mislead you. Global policy settings are still historically loose. Monetary policy has room to tighten much more significantly, leaving asset prices exposed to further potentially material downside, says Zero Hedge. This week, the Risk Bank in Sweden unexpectedly hiked 100 basis points. On Wednesday, the Fed delivered its fifth consecutive rate increase, while the Philippines, Indonesia, Switzerland, Norway, South Africa, and the UK are all expected to lift rates today. Yet, despite this flurry of policy tightening, the global policy rate, the median central bank rate of the major EM and DM countries around the world, is only 3%. This rate was more than 5% before the Lehman crisis and 15% in the early 80s. Okay, Treasuries just took a little bit of a move lower, and the S&P 500 is dropping here. Oh, you know what? That's because we had... why is Financial Juice not... Okay, so hold on. I'm not getting my sound. Oh, I'm so disoriented from that. Okay, so initial jobless claims was 213K versus 217K. Better than expected is resulting in higher rates here. Tobias, good morning. Maybe it's because I didn't have this on. Okay. But it's the inflation-adjusted version of this measure that's the real eye-opener. The global real policy rate is very negative and still close to its historical lows. It has only recently begun to turn up and it has a long way to go back to zero, let alone move into restrictive territory. This has ominous implications for inflation and risk assets. If central banks get cold feet and stop hiking while the real policy rate is still firmly negative, then there's a high chance that inflation fire will not have been fully put out. Eventually, it will reignite and even higher rates would then be needed. But that would open up a glorious window of opportunity for risk assets to outperform. Equities would fly, led by growth stocks, bond yields would fall, and the dollar would sell off. This trend would continue until it became very apparent that inflation was reviving and monetary policy was about to become restrictive again. The other possibility is that the hawkish central banker hype is true and Powell, Lagarde, et al. Hike until the global real rate is positive and then, channeling their inner Volcker, hype some more just to make sure. If they do, then risk assets and economies' travails are just getting started. Stocks would have much further to fall, front end yields would have to rise more to rise, and yield curves would have ample room to invert more, perhaps hyper-invert in the 2 and 10s case. It is feeling like that. I think that we're going to see the biggest inversion in 2s and 10s that we've ever had. I don't buy that central banks will follow through on this report at Harkinish. It's easy to talk when unemployment rates are rock bottom and widespread economic pain has yet to be felt. Either way, what is undeniable is that the global monetary conditions are already tight and that stocks and other risk assets are prone to more weakness. The global financial tightness indicator is a diffusion index of central bank rate hikes and other measures of credit and liquidity construction. It has fallen sharply over the last year and shows that equities face more downside in coming months. Most disconcertingly for the bulls, there's no sign yet that liquidity, one of the best medium-term indicators of equity performance, is about to turn up. It will be exceedingly difficult for stocks to make a sustainable rally while global liquidity remains so tight. Furthermore, there is no light at the end of the tunnel. The chart shows that the advanced global tightness indicator designed to give a lead on global tightness indicator and based on central bank rate hike expectations continues to fall, meaning global liquidity will remain low and trending down over at least the next 3 to 6 months. Yeah, they're dumping. I'm keeping an eye on it. They pulled back a little bit there. There's 5.6. I thought that 5.6 would have been. I would have thought that we'd be like 5.7 now. So I'm kind of getting my bearings here. They sure did puke on that news, though. The Japanese yen did not move. At Jackson Hole, Powell signaled the Fed would raise rates and keep them high for an extended period. This strategy, if adopted by other central banks, will keep global financial conditions very tight with little chance of near-term reprieve and condemn equities and bonds to a protracted bear market. Don't let the availability heuristic of the fury of recent rate hikes fool you. History shows we are far from the potential peak of global monetary tightness. Considerable caution in markets continues to be well advised. Even though I think this is a potential spot where we might see a peak in interest rates, if they, I mean that means that they'll still raise the next few meetings, but that the market has already priced it in. Okay, so if that is the case, we might see a peak in interest rates, but not necessarily in the equities market. Yeah. Coming through Twitter, seeing what else we might have here. Nick Timmeros, 9 hours ago, quoting Vincent Reinhardt, while Powell was understandably evasive about recession risk, he seemed to think there was a certainty there would be a correction in housing. Tell me how many housing corrections there have been outside of economic recessions. Oh, wow. That's a good take. Nick Timmeros now, the golden handcuffs of a 3% mortgage rate. Homeowners with low mortgage rates are balking at the prospect of selling their homes to borrow at much higher rates for their next homes, a development that could limit the supply of houses for sale. For sure, that's going to happen. That's where I'm at. No way I'm moving now. Still a little bit larger of a spread than usual, 2 to 3 ticks. Looks like the market is okay with this price for now. I kind of suspect that we're going to turn. I don't know if I really have to take that turn though. Gold is shooting out here. We are in a new regime, folks. The market has changed. It is not the same market it was 2 days ago. Do I really understand it? Guess we're about to find out. Order flow in this spot not giving me many hints. It's moving up and down on 100 contracts. I guess they like the 356 because the spread came in there. Well, they're calling it golden. I see what Nick Timrose is saying there. Golden hand. Yep, I have golden handcuffs. That's what it is. We need some music, boys. Something a little upbeat. I don't quite feel in the mode yet, like when I'm speaking and the words are coming out. It feels like a new bear market rally is imminent soon. I think that we're going to have a bit of... I think we're going to have a bit of drama first. I'm deeply skeptical of this little pullback rally in the treasuries because the volume is just... The liquidity is just pulling every tick. The question is really how many people were surprised yesterday. Like the way that the S&P 500 fell kind of suggested that to me that, well, actually it wasn't the way that they fell, but the reaction of the retail traders really suggests to me that they were still caught off guard. I guess that makes sense because the influencers were all telling them, you know, oh, the peak in rates is coming and yada, yada, yada. Or sorry, that the Fed is going to pivot. I'm not calling that the Fed is going to pivot, but I am saying I think that the market is fairly priced, and as such, you could get a pullback. Carl Quintilla retweeting something about a Hannity interview. What is that? What's going on? Some politics. Washington Post analyst: Democrats are fooling themselves on midterm turnout. That's one we should read. The way they sucked in trades on this move yesterday wasn't, yeah, it really was, right? No, I totally get what you're talking about. I feel the desire to take a trade, but I think that I should let this settle for a little bit. If it comes back hard here, like immediately, it might not be the lasting move that I want. It's kind of threatening that, like, if you want 3.56, you have to do it now, though. Yeah, there's an uptick. Well, I think that was probably, I'm going to put that one down as an error. But the liquidity looks better. Yeah, of course, nobody wants to bid 3555. The pivot will come in 2020. Yeah, maybe. Like the thing that I keep in my that I would keep in mind with all of this stuff, right, is that there are inflationary forces that are still out there, right? Okay, just as an example, the Japanese are still printing money, right? And like that article was pointing out, real interest rates are not positive yet. So the money is not actually that restrictive worldwide. And I really think that you have to stop thinking of inflation as a country by country thing, that it is a worldwide phenomenon and that it affects all countries, right? That means that the money supply for the whole world is going to matter. Okay, so there was a little bit of a turn. Maybe it wasn't a mistake. Gold is still rising out, shooting out here though. I want to know what this Sean Hannity interview was. Did Sean make a mistake? Trump described himself as a former president in a Fox News interview and then immediately tried to take it back. Okay. So he interviewed Donald Trump yesterday and Trump made a gaffe, basically admitting that he lost. That's funny. That's funny. Haha. So I read something on it was in the r/stock market thread on Reddit on interest rate hikes, and these guys were pointing out that, you know, because people are retiring and all sorts of other things, that the labor market may remain tight for a long time, despite what they do with interest rates. I thought that was a really interesting take, and I can totally see it that yeah, unemployment might be okay. Now, maybe that's a good thing. Maybe that means a soft landing is still possible. I don't know. That one doesn't quite jive for me. I guess we'll see. Okay, there's another tick. 365. Seems like the treasuries can move quite a bit before for a corresponding move in the 10-year. In other words, the DVO1, it seems to be lower than I'm used to. Good morning, Stephen. I did get all of your licenses activated, by the way. Both of them. Okay. Mashun, man, what that? I can't even read that. My son. Is that... Okay, interesting move there. So I'm noticing some changes in the spreads. So we have been kind of steepening here this morning, especially in the 30-year end of the curve. But at the moment, the 5-year looks pointed down, and they look intent on flattening it back out. It looks no. Well, maybe the 5-year is turning around. Or no, the cumulative delta in the 5-year is down, but I can clearly see the spread steeper right here. Is it a Middle Eastern? Wait, is that the second part of your name? Is that like a real name, or is you put all of the little flourishes on it for fun? That's pretty crazy if that's how a real name is spelled. I get a lot of people from the Middle East. I appreciate it. I mean, I'm not a huge fan of Islam, but I really like Middle Eastern people. I guess I like all people. I just find other cultures and countries so interesting. You know, and anything that's new, anything that's a little bit new catches my interest, I guess. But I've had a lot of them here on the stream. It always surprises me. Okay, that 5-year is driving. Look at that. This is about like 3-4 ticks higher now. And yanking the other two along with him. With her. They're ladies. I think that futures instruments are ladies. Well, I can see the Japanese yen kind of pointed higher. Oh, nope. The 5-year came back there. Well, kind of happened fast. So it's probably not done. That 30-year hasn't really moved. 30-year is still just kind of chilling at 130.10. Well, down tick. It feels like maybe they're fighting it a little bit, but like honestly, the volume is like it's less than 200 contracts per tick these last few ticks. I have a question. When watching the DOM, how do you know the orders executed are of a new or old ones being executed? So do you mean, how do you know if it is opening a new position or closing an old position? You can't know for sure. Sometimes contextually you might know. Like if a piece of breaking news hit and a bunch of market orders hit the market, right? Those are probably people opening positions, right? But there's no way for us to really prove it empirically whether an order was opening or closing a position. Now, at the end of the day or the end of the week, you get like open interest and commitment of trader reports, and then you can determine those sorts of things, at least on a weekly basis. And I've found that overall, you can predict what those reports are going to say. So, but like here's the thing. The past orders are not very predictive of the future orders, right? So I don't necessarily have to worry too much about whether the orders that I saw were opening new positions or closing hold positions, but I can come in and predict an order flow that people are going to open new positions because of we had the non-farms, or sorry, we had the unemployment claims, for instance. You could say, well, because of the unemployment claims, people are going to open positions short, which is what it looks like happened here this morning so far, right? So when you're making a prediction, right, then you kind of know, right? You have a video explaining? Yes, I do. So I have like a 4-5 part video series where I give you the basics of what you need for the DOM. I have a couple of videos on the DOM. And then so there's one where I talk about the basics of the DOM. There's one where I talk about large orders and spoofing. I talk about the empirical properties of order flow and the inelastic markets hypothesis. You have to understand that a lot of reading the DOM is just kind of the experience, but you gotta understand what you're looking at first, right? Just I don't want you to think that you're gonna go and find a video where I'm giving like specific entry conditions or something like that, right? I'm trying to help you understand what you're actually looking at, because the real edge is going to be having a predictor of order flow and being able to judge whether you're seeing the flow that you want or not. So, for instance, today we're seeing we have currency intervention out in the markets, so that's why I went short rates. And when I look at the cumulative delta, particularly in the 10-year, it continues to rise even after that really big pullback, right? So it's a tough read because the market is moving on very, very little volume. The liquidity is not as good as it was yesterday, and the liquidity is pulling a lot, so that makes it difficult to read. But the overall market volume is going the way that I want so far. So we'll see if they recover this down move that we had. They did come back to basically where they were before the unemployment claims. So, but sometimes people are buying and the market is going down. Why is that? Okay, well, so sometimes you could see a situation where a market. So, for instance, yesterday we were down even though the treasuries were buying it. And the treasuries continued to buy it and completely reversed that move, right? So how do you get that kind of a divergence? Well, that's just the market orders, right? So there can be situations where the limit orders overwhelm the market orders, and we move in the opposite direction of cumulative delta. That's a less common scenario, but when you get flows like that, it's more likely to be market making, maybe a really bizarre currency correlation, or just general hedging activity, right? So it's just another type of flow that you'll see that you can predict. And so if I'm coming in, if I was yesterday, just for instance, as a good example, you were around yesterday, I think, and that Fed news hit, and I said I want to go short. And then after 5 minutes, I see that the cumulative delta is still rising. I probably dumped that trade because it's not the flow that I was expecting, right? The marketeer asks, are you bearish? You're not alone. And then it shows a chart of sentiment is just really high bear percentage right now, 60%. Ed Morrissey, Putin may have intended mobilization less as a signal to the West than as a rallying cry for his subjects, and even then it's backfiring. Yeah, no, I don't. I think it was a message to the West, but we'll see. I'm sure that when this is all said and done, that we'll get more information on that. So I guess the big takeaway there, Mustafa, though, is don't trade cumulative delta, because I think that one of the easy things for a beginner to do is come in and look at cumulative delta and say, okay, cumulative delta overall is trending up today, so I'm going to go long. Wish it was that simple. I should also note that some markets are more likely to do these divergences than others. So in the treasury market, to see a divergence between cumulative delta and price in all three instruments is extremely unusual. I don't think I've ever seen that before outside of yesterday's move. Okay, but in the S&P 500 happens every day. Some of the strongest trends that I ever saw were pushing against the cumulative delta the entire way. So you're getting short, quick little jumps higher, but they keep coming back to this 24 area. And the 30-year in particular seems to really be lagging. So what I'm getting here is that the steepener is not beneficial for our trade, right? Yeah, I don't like that. And that was a little bit further of a fall too, with the 30-year dragging them. I'm still seeing the 6J. Well, okay, so that's a British pound. Sorry, I need the 6J over here. The 6J still looks like it's reaching higher, though. Whoa, 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 whoa. Oh, the 30-year just got creamed there. This, wow. I haven't seen something go against me that quickly in a long time. Man, I was trying to get out at -10 and it just started dropping. Wow. The flow changed so quickly. Well, I think that move really destroys my overall strategy today. I could flip around short. I'm a little skeptical though that could be because of the spread. Like that could have been them selling the 30 and buying the 5 too. And so that move down was just, you know, the extra selling in the 30-year that kind of screwed us up. But from the way that played out, right? Because I got like 10 ticks favorable. How did that play? What was that in the end? 13 ticks favorable, 19 unfavorable. Ugh. Really wish it had been better than that. Could have been worse though. I really wish I had gotten out at 10. I was trying to get out at 10 and it didn't. I was gonna hit out with a market order. It didn't go, and then it came away from me. So I was very flat-footed on that move. But look, the 5-year is not anywhere close to its lows. So steepening. at that. So it's still moving around on very little volume, but it's more than it was. So they're trading like 5, 6s here now, quite easily ticking it down and down and down. I'm not quite sure I see where that particular drive is coming from. I guess the Japanese yen is pointed down a little bit at the moment. And the oil is moving up. I'm not sure what's going on here. But look at that. There was another 15 ticks if I had tried to hold on with that. Ooh. So on the Japanese yen intervention bit, okay, every bit that the interest rates go higher, right, the more dire it is for the Japanese yen. So if we start to see like weird walls formed up here, I think that we should probably give them heed. Yeah. Did slow down there. Oh, good morning, Scott. Tough to watch this. That's another 20. So it just dropped 4 basis points just like that. Literally within the course of 5 minutes. It's a very strong move down. Seemingly out of nowhere, and not on a whole lot of volume. I guess the volume was in the 30-year, but overall not on a whole lot of volume. I'm not yet to the point, though, where I feel like I should treat this as it's just going to trend down all day. Because to be honest, I'm not entirely sure why we saw that downflow that we did. I'm still thinking that it was probably just steepening. It's just that if we're getting the steepening, might not want to take the trade that I was doing, because you're not going to get as much out of it in our 10-year. Like if it is steepening, we probably want to do it in the 2. In moves like this in treasuries, is this some kind of hedge against another asset? Well, so I think that the Japanese yen is a really big part here, right? Because the Japanese yen is having currency intervention. But somebody might be coming in and making a bet. You know, it's a little difficult for me to tell in this situation because the liquidity is not very good, right? The liquidity is not very good. So it's a little dangerous to trade. Like my takeaway from that last trade is that this is a little bit dangerous. Okay, so they are giving us a little bit of support there. There are options for treasuries. There are options on treasury futures, rather. So they stacked that 17 as kind of, I think, a like, okay, this is turning around sort of a thing. Look, okay, so 1594 traded at 18. So it is now starting to do more volume here. The 5-year reached a new swing low, but only by a tick. And they're taking contracts there at 17. Oh, look at that. Okay, so there was a large order at 17. As soon as it ticked down, somebody hit into it with 1,000 lot, and it did not shift. This is a little risky, but okay. Uptick. Didn't hold. Like the DNB vibes. Yeah, I thought that we should go for something a little more upbeat today, so. Okay, some iceberging at 17.5 on the offer. More trading into 17, but it doesn't clear. 4,000 at 17. So there's the iceberg that I was talking about. I was right. There is a big iceberg down here. Problem is the 30-year. You need the iceberg in the 30-year too. It looks like, oh man, there's some big transactions going on here, man. There's some big money trading hands at this spot. Which is not necessarily what I want to see. The transactions, like, you could be thinking of that as possible central bank action there. Nope, they broke through. Darn. Well, I said that was kind of a risky place, so. This, actually, cumulative delta-wise, this is a lot of selling. So somebody did put up a fight there. I thought it was worth a play. But clearly now... So to answer the question, do I really understand this market? I think no, I don't think I do. Maybe they are just going to fight the Japanese yen. I don't know. Not sure I see why, yeah. If USD goes up, do bonds go down? Kind of. It's really if bonds go down, does USD tend to go up? Yes. But that's only the current correlation. It's not a hard rule all the time. Right? Like if we were in a quantitative easing era, then you would likely to see the dollar go lower and treasuries move up. Looks like the Swiss are doing work. It could be. What do you think? Success? Could be. What I see here is that the Japanese yen did push down, so there is currency correlation with it, but it was not the direction that we wanted, was it? We are seeing volume the other direction though, or like like there's a big iceberg there at 17, for instance. I really thought they were going to pull it out. Okay, following decisions by the Bank of England and the Swiss National Bank, Citi starts a short position on the Great British Pound and the Swiss franc with a target price of 105. I think that these currency flows are just a little bit too complicated for me. Look at that. Like, they're not backing off in the treasury at all either. Okay. Well, that spot was a little better. There's a good bid there at 14 as well. So like the problem here is so if we're getting big trades going through in the currencies and stuff and like people are battling it out, right? Then that means that we could get really excessive volatility where like we had a strong move to the downside. We could get a countering trade to come in here and push us very strongly the other direction now as well. We're filling singles. Well, so was that? Oh, okay. So we weren't quite to yesterday's lows. That was at 09.5. See, it's screaming to short rates here again to me. I think I need to see a little bit more in the 30-year before I'm really convinced of this. Because they're still selling the 30 really hard. Look at that. Maybe this is headed for a new low. Well, jeez. I was about to try and put a limit order at 01.5 and they just whoosh. Whoosh. Yeah, something wild is going on in the 30-year. Really? Again, they're gonna go again here. See a big stack at 12.5. Okay, World Bank president is speaking on CNN International saying that a sharp slowdown will extend into 2023 is what it looks like. That's his prognostication. Okay, after that really sharp, quick move lower, it is flipping back around. So they are vulnerable to a trade the other way here. Although that was a lot of volume sell there in the treasury, so I I'd be a little bit nervous about trying to flip this the other way, right? Oil is pushing higher. Jeez. Missed it again. I thought I could rest for a little bit. Nope, there it goes. Wowzer. I'm too picky. Nope. No way. No way that one's happening. I think that can only happen so many times, right? So here's yesterday's lows. Man, I missed out on that one. I was trying to catch a one. I feel like such a terrible trader at the moment. But I can't jump on it now. Not now. Look at that. That's nutso. Look at the way that the offers are stacking on this move is a little scary. Was definitely on the wrong side of this. That was a big stop out too. Remember, 09.5 was the previous day's low. Man. Well, she's got a little fight in her here. Now all of the headlines are going to go out. U.S. 10-year Treasury yields rise to 3.644%, highest since 2011. There's 365, dude. Fuck. Screw me. You think there's like, well, there's no way I can jump on this now, and it just keeps moving. I mean, and so quickly. This is a little crazy. Well, that might have been the end of it. The volume has certainly changed here. The one that pisses me off is that I was looking at 3615. if you get 135.13 on UB, oh jeez. Well, I wish that I was as hesitant on my short interest rate trades and more as aggressive on those trades as I was, on the ones I missed. It was completely backwards. Although it does look like there's a change here. So I don't think that change necessarily would make for a good reversal per se. I mean, if large orders come in swinging the other way, it could definitely flip back up. I don't know if we're actually going to see that or not now, though. I don't know. The sell flow was very unexpected on my part. I really thought that we'd be moving up because of the Japanese yen currency intervention, but the sellers came in hard. There's back 09.5. Looks like we might be getting a... That was the pullback. Maybe the pullback is already over. I can see some of the selling coming back in. Whether or not it's the Bank of Japan or anticipation of the Bank of Japan, who knows, but it's noteworthy that the belly, a central bank reserve holding favorite, is leading this acute downside in lack of much else. I think he's talking about the selling in the 10-year. Okay. Really, really massive order in the 5-year. Sorry, my lips are really chapped this morning. You know me, can't handle a moment of discomfort. Just drives me crazy. Yeah, it was a 2,500, and they're running away from it too. Well, there's going to be a bit of fight here at 09.5, okay? And there is a big order on the upside in the 10-year, so. Well, it only briefly went bid at 09.5, but even for that few seconds, there was a couple of market orders willing to hit that at 10, which is a little odd. Even though liquidity is still light, it's starting to act a little bit more like normal treasury, you know. When it ticks up and down, it fights the tick a little bit. Wouldn't say they're shying away from it, but for now the ticks have been not going into it. And 6J doing pretty similar thing to the treasuries at the moment, so. No, this is already. So I'm gonna hold off here. That was another one I probably shouldn't have taken that last one. That, and on that sell, it was pretty compelling volume to the downside again, but let's see what happens with this big order at 05. Here's the ES open. Wow, it's early. This is gonna be a long day. Wait, what? Look at that. Look at the stacks on that. What the hell? Jeez. So I'm a little weirded out here. I don't know how I got into that. My DOM is being weird. And unresponsive. Okay. Okay. No, I don't think it's Jigsaw. I think that I think that the data is having a hard time keeping up. This child is, I'm so pissed. Okay, hold on. So with Jigsaw, when I'm on sim, I will get kind of lags, but not on placing live orders. So I think that usually when that starts happening to me, like my data is being slow, or like my NinjaTrader is being a little bit too, like I need to take things off NinjaTrader. Don't look at me like that. Can't be left alone for more than 5 seconds. But this chop down here, I should not be participating in, so it's okay. No, it wasn't the bridge, because it's coming. So let's see here. Yeah. So first thing here is that I need to okay, so that helps. See, my CPU is at like 66%, and it's NinjaTrader is taking up the majority of it. So what's happening is when the data is really coming in, my NinjaTrader is having a hard time processing it all. Because I just have a little bit too much stuff going on. Man, if they go for another leg down, I'm going to be so stunned. It's certainly doing stuff that could be a bottom, but the problem is that we still don't really know what drove the volume. It was really an insane move, right? She really thought that he was gonna stay asleep and that it wouldn't bother me, but as soon as she left, as soon as the garage turned and she's been leaving them here instead of taking her with her when she drives the kids to school. I think that we're gonna have to change that. It's definitely looking like it's doing something where you could get a move the other way, but taking the trade the other way seems a little too scary now. Can't believe that this was originally at 3.61, so $50 move the other way is really something else. But you gotta be careful, because so like, if I had been short, seeing a distribution like this is like, I've got to take some profits. I think that a lot of the time when you get a move like this, that it will kind of do this middle here a little bit, and then much later in the day it will drift a little bit lower. But the other possibility is that somebody could come in and buy it up. Somebody could try and spike it the other way. So this is a good spot to protect profits, but maybe not necessarily to take a long. Yeah. $6J is making another push lower. This is why I'm like, I think we got to stay. Any other day, I would see that right there and be like, well, the trend is probably over. It's not worth playing anymore. But the 6J is moving lower. It looks to me like there is more to this game. Question is, at which point do the Japanese step back in? Just that last move down, okay, where we extended down to the lows again and everything, had a lot of volume on it and did a lot of damage to the liquidity. So you know that you're at least going to get a slow down, pause, pullback of some sort in this area. But again, if I was tactically looking to go long, and if I was the Japanese yen, if I was Japanese doing my central bank intervention, okay, and they just pushed it really, some traders just pushed it really hard against me, and I want to intervene again, I'm gonna do it right here after the liquidity hole forms. So that's why we got to keep an eye out for it. S&P 500 looks unhappy. I myself, I've calmed down quite a bit. So I'm wondering, if I put an order in now, it's almost instant. It really was. So another thing was that I had some recording going on over here. That was taking up a little bit of processing too. Oil's up 3% today. See, down tick like that makes me want to go. Makes me want to go take a trade. Well, I don't think it's going to happen. Okay, who is Kwasi Kwarteng? British politician serving chancellor. Okay. What kind of math level do you need to understand the financial books research that comes out? Oh man. Well, some of the research that I've read is very, very advanced and is well beyond my level of understanding of math. I think that you don't at least want to have some calculus under your belt. Jeez, look at it. Like we were sitting there at 04.5 and I was like, well, I can't. It was a pause, but they're going down for another leg this fast. It would do it at a point where the least amount of size can yank it around, not in a whole. Well, but that's what I'm saying though, is like you want to do it right after the hole forms because your impact of your buy orders will have more impact here across this hole, and you want to do it as soon as you can after the. So there's kind of a little point at which it's decayed enough where your buy orders will have the most impact. But I don't think it's coming. I think that they might have to come all the way back down to the intervention point. $113 even MAC options pane. Yeah. So this kind of action is frustrating. I mean, I've definitely felt this before, right? Where you're getting a long trend, you're the wrong way on the trend, and then when you decide to try and go with the trend, you miss it, right? You miss it, or when you do get into it, it doesn't go. You get scared out, etc., etc. You just kind of get off sync with the market, right? Okay, so there was a big offer there at 03 that got taken. And big changes in delta on that move lower again. The change in delta on this is scary. Something like really big is going on. Like a sovereign nation is coming and puking all of their bonds or something. You know, relatively speaking, the dollar is not moving as crazy as the treasuries are. Since the balance sheet is shrinking, it seems these intraday reversals to the upside. Well, I you know, just the downtrend is such that you probably don't want to fight it, right? I was only fighting it because of Bank of Japan. Thanks for leaving me hanging, Japan. This has been one doozy of a down move, though. That move, we might be getting the... Was it really all the way 06? Ugh, I don't know. So the way that this is going right now is like they had to balance at 06 and then they very quickly pushed further again. So I would often be taking the reversal trade here for it to go back to 06. But this move is something else, so I don't think that one makes sense. We're trading the yield futures. We're trading 10-year yield futures. Shrinking balance sheet support makes re-hypothecation expensive, even more so when the expectation is it will shrink further going further. Well, the thing I'm worried about here is what this does to liquidity, right? But I guess my point earlier was that the trend is but this is like one of the strongest on a high time frame. This is one of the strongest downtrends you're gonna get. So that whatever the reason is, that's gonna make it really hard to get really strong pullbacks. We haven't really had like big intraday reversals lately, except for yesterday. Don't forget to exchange the dollar for the yen now before the dollar reverses. I think that we are to the point now where the market is just... So there's like a limit to your... There's a limit to your... what, man? My mind has gone to mush. Okay, there's a limit to your impact, but then there's a point at which the market just unhinges. And we may have passed that point. Shay says, I think it will probably improve. You will have increased turnover. People will want to hold risk on their own books for as short term as possible. Oh, that reminds me. I saw the dumbest thing on TikTok. There's this modern monetary theory person that gets on there. And they were saying that, you know, higher interest rates will cause middle-class people to sell their bonds because they think that they're getting the highest rates possible, and then they would turn around and use that money to buy things in the economy, and that could create more demand. I was like, that is the most laughably stupid thing I've ever heard. Like, if you're selling your bonds here, you didn't make money on it, okay? If you owned bonds and you're selling them here, you didn't make money on it, and you're not thinking about taking the proceeds of that and buying toys. Getting clicky still. I think that this is worth playing on Sim. Whoa, that's genius. That's exactly what I hear from the freshman econ peeps here, whom I got assigned as a TA. What? Like the thing is that the way that she said it was like made me think, do you even understand how bonds work? Because she was like, because you're getting the highest rates you can get. She made it sound like they're buying it because they want high rates. I mean, they could. She's not like backwards in terms of, you know, how bond prices and rates affect each other, but her language was backwards. Right. Her language was like, these people are making money, they're going to turn around and go and spend it now. No, you lost money if you have bonds. It's not going to be that's not going to be inflationary. You're just going to put it into cash and hoard it. Probably. Now, on the other hand, part of the thing here is to create an incentive to buy it at some point, right? There's a certain point at which the interest rates are supposed to be high enough that it creates an incentive to buy. The problem is that your real rates are still negative. So well, that's not looking so hot. I'm gonna let it go. Yep, there it is. Flat. So we're reaching the point now where the initial Japanese yen intervention took prices to in the yen. So we are seeing a little bit more iceberging down here. Although they continue to push, I suspect that they're going to try and take it to 113 even. And again, the cumulative deltas on all of this are a little insane. So who do you think has sold this? I think I haven't been this off kilter with the market in a long time. I feel out in the loop. Surprised that we're still seeing like 2Ks out there and stuff. that move to 113 feels a little bit more resolved. Like the deltas are not just like constantly falling now. There's kind of a little bit back and forth now. I'm not so sure that you're gonna see a reversal though. Kind of feels to me like the Japanese had the spot that they wanted, and as long as the yen doesn't come all the way back to it, I'm also worried that if we do get Japanese bank intervention, that it will be like in the form of a big headline that pushes us up very quickly, and then we won't be able to take advantage of it. Just reflecting on this market here. You know, that was a pretty wild move lower, but at least so far, the equity indexes have been faring okay. It's to the downside, but they haven't like fallen apart yet. They're not to like overnight lows. Bank of England raised its rate by 50 basis points in a 5-4 decision. 3 officials wanted 75 basis points and 1 wanted 25 basis points. Really? Still some big stacks on the offer. I wonder if I'm being crazy here, like that, you know, this is a move that goes all the way to 4% or something like that, and I'm just kind of sleeping on it. Like that my disbelief at how far it's has gone is, you know what I mean? Right now, though, this does look like a pause. Mortgage rates jumped to 6.29%. Maybe they do. Maybe I do come back to the price that I bought my house at. That would suck. I think I've still got plenty left in there, but oh, you had one of your best days in a while, but before the big move, that's curious. Well, so the thing is kind of like when you do have a bad day, how much damage is it? So far today, the damage isn't terrible. Should have been a little bit lower though. That's where I kind of kill myself. Is like when I'm slow. I'm slow on the no, something else is going on. Right. Like as soon as this drop came here at like what was it? 113.12 is when I should have been like, maybe we need to go short. How do you calculate the futures rate with the current? You can't. Well, so this is a complicated thing. Basically, the thing is that you have to realize that the future is a derivative. Okay. So if you go to the CME website, they do give you like an interest rate that you can calculate based on like what the DV01 is and all of that sort of stuff. But that's like only a temporary calculation because it changes constantly. And so you go and use like, what was the rate like 5 minutes ago and how far did the futures move and now what is the rate now? Doesn't work like that. And if you want to do it from the side of like, what are the micros? What should the micros be? Then you have a problem because the micros have a basis involved. See, it is not stopping. Holy shit. The oil is coming all the way back now. Like the only thing that you can do in this is go long rates and pray that you got a good spot, really, because there's so much volume coming in on this. Like it is almost like net 50,000 contracts now. And even though there's some pretty big icebergs here in this location, they're filling them. Oh man, and spreads are flattening considerably. Okay, a couple of significant clicks there. So remember earlier I was talking about, well, where if you were going to time some currency intervention, where would you do it? And I had identified a spot where I think that you would have maximum impact. But I think that the issue here is more that there's a lot of contracts to sell for some reason. Like whoever it is, it's going to be like a big country is like dumping everything that they have. Is kind of what this looks like. And you might want to just wait for them to finish, you know? Yeah, it looks like it will reverse any moment. Yeah, it's felt like that every step. It always feels like that when you get trends like this. SMB hiked 75 points to a now positive 0.5%. Apparently, market was looking for more frank hit. Well, there's 3.67 again. The 10 years at 3.51. So what's this 113 on futures? What would you know how that is calculated? No, you can't. Let me walk you back through this, FDH. I need to look away from this for a little bit. It's getting to me, man. Yeah, so there's a couple of issues. Let me give the basics here, actually, and then you can interject, because I know that there's some parts that are missing, because there's a way that they calculate this, right? It's just that we don't have the data to do it, okay? So if you come here to their interest rate tools, and there's like Treasury Analytics, right? So it will tell you this information, right? So I can come into the 10-year, okay? Here are all of the different coupons that are deliverable for the current futures contract, right? And here is what the yield on those all are. Now there's one that will be cheaper to deliver, and that usually ends up being the youngest one, right? So that yield is 3.86%, right? But this is not up to date. This was like yesterday's close or something like that, right? The last price was where is it? Oh, well, we can just look at it up here. Price 113.01 and a half. Oh, it was only a few minutes ago. 113.01 half. So at 113.01 half, the yield is 3.8. Makes sense? Which is a little odd, because the 10-year is 3.65. But, right? Now, the thing is that if we had moved all, since this is not up to date, okay? Just note, this is not up to date. I guess this was taken like yesterday, okay? So you could come in and you could say, okay, price has changed. How far have we moved from the current price? And what is the futures DVO1, right? And then you could look at the change in price and the DVO1 to calculate the theoretical change in yields, right? The problem is that the futures dollar basis of a basis dollar value of a basis point changes. So it'll say 3.6 or 65.44, but it might be 67 now, right? And so to get it like exact, like to get the calculation within a basis point is hard. Yeah. There you go. Now we know when the first day of delivery will be. Substitute the price of the 6% hypothetical bond and the cheapest to deliver, and you get the ZN price. So I think what actually is saying is you can calculate in December, since we are trading December now, right? Yep. In December, what should that be worth, essentially? And then you say you use a 6% hypothetical bond, and you'll get like the conversion price. But you have to go down and do the actual math of like, okay, if this is what the current, if on a coupon of 4%, this is what versus the current one, and it's a mess. So you have to use a spreadsheet to do all that junk. And you have to take into account all of these little oddities, like when is the coupon paid and how many days there actually are, and you know, things like that. But this is the closest that you can get. There you go. Now, why the DV01 flies around like mad? Because it depends on the repo market. The bond cheapest to borrow and lowest accrued during the borrowed period, which depends on supply. Yeah. Like it, I guess to be simple, it can be calculated, just not with the data that we have. Because we sit down and we think, okay, I can see the price. I should be able, shouldn't there be a corresponding yield for every price? Doesn't work like that. The prices and yields are roughly correlated, but they float against each other. So if you have a Bloomberg terminal, you can calculate it. But I don't have the data to calculate it. And furthermore, if you're trying to do what I was looking at, which was use the price over here to determine what the price over in the micro yield futures should be, to try and bring in the yields on like these 5 years, for instance, right? That doesn't work because the micro treasury yield futures expire every month. And so there is a basis between the cash treasury and the micro treasury futures, micro treasury rate futures, or whatever we call it, yield futures. And that basis is anywhere from like 1 basis point to like 4 basis points. So that's why, like, when you look on the 2 year, there's always at least a basis point spread. Oh, now why I said the only delivery price is concrete, all this becomes moot because you now have a choice to either borrow from the repo market or pick from your own holdings, which are available free. I get you. Basically, there's a bunch of different ways to hedge yourself and deal with it. So it becomes complicated as to which one you want to do. You don't want to be doing calculations to determine what's the best. Well, that was the strongest pullback we've had. I do kind of suspect that we'll eventually get sucked back up to 07, but five years already turning back down. This is a stunning move. It really sucks to be on the wrong side of a stunning move, to be that off kilter with the market. I guess, you know, you could have said, well, rates are going to continue rising because of what the Federal Reserve did yesterday, I suppose. But I really thought that the treasuries yesterday said, yeah, everything's fine. This is where we thought it should be. Somebody executed the Godzilla meta order short today. Yeah. Like I think it had to have been a sovereign wealth fund, right? I think that when we get into next month, that we're going to look at the foreign holdings, and we're going to see that a particular country's foreign holdings of treasuries changed big time. It's coming back. Maybe we could have taken a long at 3.66. You could do an exercise on the TN price. Use the TN price as the bond price, and the coupon rate as 6%. Date of purchase as first delivery date. And maturity 10 years from that, and see what the yield to maturity comes out, and see how that correlates to the Fed benchmarks. I think you kind of lost me when you started saying the date of purchase is first delivery date and maturity 10 years from that. Done properly over the duration of the contract, you will get a basis carry equal to the 3-month ED yield. Ooh, okay. That part I think made sense. It is complicated. I think you would really need to send us a spreadsheet to really for us to really understand it. Then I could walk through. Right. So the first delivery day is the first business day of the delivery month for Z contract. It is December. But how do I use that date? Which would be December 1st. So hold on. I'm pulling Excel up. Think over. So what I'm saying is, okay, the end price is, where are ya? Sorry, TN. TN is 119.27.5. Okay, that's TN. TN price. Okay. First delivery is 2022/12/01. Okay. And the coupon is 6%, right? So if you're getting 6% per year, well, because the end track's about 9.6, but let's keep it simple. Okay, so I think that I do something like, oh, sorry, this needs to be 0.06. A coupon. Maturity is 10. Okay. So I think this is something like the coupon. Oh, no. We do E to the RT 119.28. Let's use 119.28. 119.28. So I think that we're saying this is something like this. Oh, actually we need to, sorry, escape. So now we need to convert this into like a real price. So let's insert. Okay. Adjusted price is equal to 119. No, 20. But we could just say this 120, but no, we'll do it. 28 divided by 32. 28 divided by 32. 875. Okay, so it's 119,875, right? Yeah. Okay. So I think that what you're saying is 119,875 times E. Oh, how do I do E in Excel? Excel E. Is it EXP? Yep, you're right, EXP. Oh, EXP given to the, okay, so 2 times, right here, EXP time to the rate times the holding period. Yeah? And then I get this other number that is how much I would have after the time period, right? How much my investment would be after 10 years. Okay, but then what? So where does the first delivery bit come in? This is if I, no. Oh, well, isn't it? It's not continuous compounded, is it? Huh? Yeah, no, you're right. They're 6-month compounded. So we could do other what? So the other way would be, would it just be times? Would it just be times the coupon times the maturity? Plus the original investment. Do half the coupon times double the, wouldn't that come out to the same thing? All right. 0.5 times, yeah, so half the coupon times maturity times 2. That would be, because these two cancel each other out. Anyways, I guess maybe even for some other situations they wouldn't cancel each other out. Okay. Plus, no. Plus the original V2. Okay. And then we got this equals this minus this, right? Wait, what? B6. Oh, no, 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 no. That's not right. There you go. There's a Y2M function. Okay, hold on. I would kind of rather do it myself, but oh, this doesn't give me what the want to see what the inputs are. Is it yield mat? Returns the annual yield of a security that pays interest at maturity. Okay. Settlement. Oh, geez. Okay. I'm wondering what the appropriate. Well, we'll just try it. This is the settlement is the first delivery, right? Oh no, wait. Settlement is just use yield. Okay. Just use yield. So the settlement would be here. Okay, but it would actually be 2032, right? Okay, equals yield settlement maturity rate. What's the PR? What is the PR here? What does that mean? Yield the function. That's what I was looking for. PR. The security's price per $100 face value. So that would be this. I'll change that. Yeah, PR's TN. Redemption would be, okay, so they say the securities price per $100 face value means it's 100, right? Because these are $100,000 bonds. Frequency, 1 for semi-annual, and basis is optional. And this should be 119.875. Okay, so I didn't like that. Yeah, redemption would be 100. Oh, frequency is 2? No. Frequency equals 1. Oh, for annual payments, frequency equals 1. For semi-annual, frequency equals 2. Okay. 2. Doesn't like it. It says not a number. So what did I get wrong here? Settlement. Maturity was 10. Coupon, which is B4. 0.06. Purchase price is negative? What do you mean by that? Which one of these numbers do I change? Here, let's do it this way. Okay. Oh, okay. No. We can type it all out. Settlement. So settlement would be 12/01/2032. Maturity is 10. Rate is 0.06, or maybe that should be 6. PR is negative 119.875. The redemption was what was it again? 100, and frequency was 2. Here, now paste. Maybe the rate should be just 6. I doubt that, but nope. Oh, the 10 is wrong? The maturity is not 10? Oh, the security's maturity date. Okay. Is that the same as like 12/01/2032? Or do I have to say date? I have to say date. Yeah, 2032 12/1. Do I make the settlement and the maturity the same date? Gotta go. Sorry, Chris. Catch you tomorrow. Man, they did go lower. I was kind of thinking, should I be trying to take another trade instead of doing this? Wait, what's the yield that we got now over there? 6.8. It would have been worth $20. I don't think I should take any more trades today. I think I have done enough damage. Okay. So the settlement and is the maturity date the date when the security expires? Settlement date is the date after the issue date when the security is traded to the buyer. Oh, okay. So this one is 2022. This one is okay. Still doesn't like it. There's now I got that. Tried just putting, well, that was this one up here, right? Oops. Is this where maybe it doesn't need to be negative? Da, 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 da. Oh, 361. Hey, that is about what it should be. Yeah. Oh, this one is slightly different. Yentervention. Dude, Kyle, they left the Japanese left me high and dry because they haven't, it's just come back ever since that. I don't get currency intervention. Took a little hit. And it just keeps going down, man. Like, the downtrend on this has been a little batty. So now I'm sitting here. What did I do in the difference between these two? Oh, 857 versus 875. This should be 875. Now they'd be the same. There we go. Okay, so the yen was under pressure because the Japanese central bank continues to be easy and saying that they don't expect to be raising rates for at least 2 years. And they started to cross their line, so the Japanese authorities or whatever went in and started buying yen with their dollars that they had on reserve. And so the Japanese yen saw a big move up. You saw a decent move higher in the treasuries. But then around the top of the hour, when the equities players came in, they all went short the treasuries. So, okay, so to go back to the conversation that we were having earlier. So this is yield to maturity. Okay. You're saying that the yield to maturity plus some basis in the repo market would equal what I should get on that treasury analytics tool, right? Try adjusting it with the 3-month yield. Oh, yeah, sure. Wait, do we have one? Did I close that tab? Patch. I hate it when I do that. I think we get the data for that over on this sheet, right? Oh, not on that one at least. There's also this oh yeah, the Treasury Watch tool. No, not on this one. There is a symbol that's a 3-month though, right? Okay, markets, interest rates. So for $0, federal funds. There's only 30-day federal funds and futures. Could maybe use swaps too. Read, what would a buyer pay over the life of the contract if he bought at the start of the contract? The seller would want to be compensated for holding the securities as a hedge for his short on contract. Current euro dollar at the front. Oh, okay, we'll do that. We'll use $0. 9.5. Oh wait, I don't even know what that number means. Oh, that's funny. Specs. Contract grade R equals 3-month London interbank offered rate for spot settlement on third Wednesday of contract month. E.g., a price quote of 97.45 signifies the deposit rate of 2.55% per annum. What the fuck? That made zero. Hey, Jeremax, I haven't seen you in a while. That made no sense to me at all. GEU. Oh, 2023. This one right here. Okay. But 96.04. Gotta do some more math. What was that, 2024? Okay, 95.315. Okay, let's go back and read this. Specs. Deposit rate of 2.55% per annum. Oh, so are you saying that it is 100 minus this divided by 4 because that's an annual rate? Yeah. So the interest rate, the deposit rate, is the amount that is missing from 100. So 97 price quoted in 3 months, 3 means 3%. Gotcha. I didn't know that you knew this kind of stuff, Chair Max. I'm impressed. Okay, so we're saying that now we can delete this one. So we're saying that this plus this. Oh. There we go. No, that's not right. The money in the future. Oh, okay. That actually makes a lot of sense. It looks scientific. We're trying to calculate the 10-year yield. But that, if I add those two together, that gives me 0.047. That gives me 4.7. That's the rate is too high. Yeah, wasn't that what you were saying? No. Okay. So now that I have that, what do I do with it? Now that I have this number, what is that number supposed to be about? Oh, are you saying... Are you saying I need to find out what 1% of this my price is? Sure. Suppose you buy 100K in face value and hold for 3 months at the 3-month rate. Then that means that you would have to pay $3,000, right? Or, well, I mean, $3,000 that you would have lost if you had just had it in at the... Oh, 3,000 for the whole year. Yeah, sorry. 3,000 divided by 4, which is like 0.75, something like that. $750? Yeah. $750. Now adjust 750 in your original yield. Okay, so you're saying this price is 119,875. And you're saying 119,875 plus or times 1 plus this number right here. No, what the hell did I just do? That not make sense. How did that come out to 260? $119,875. Right. Okay, so. We'll do it this way, 119,875. This plus this times this. There. Is that better? 121.27904 is our adjusted price. And then we're doing the yield to maturity on that, and that's 0.03464. But that's still pretty far off. That's further off than the prices we're getting right now. Zero the interview. Well, I wouldn't make it in ops. Ops or finance. I'm not sure what you're asking now, Jeremax. Oh, he's telling the story. What is the price of 100 strike dollars? Zero. The interviewee answers right. This is a good answer. What about the put? Silence. Lengthy answer. Oh, infinite? Yeah, the 10-year yield is up 5% today now. Is that right? It's zany. And like, it's not stopping at all, right? Oh, he is asking about a similar question to what I asked you that day about fix in case of SP dropping. It's undefined. It means it would mean that like the financial system blew apart, right? So the amount that the put is worth wouldn't matter because the financial system would be, it's also zero, essentially. What will VIX be if the SP dropped 1.5% every day for the next 60 days straight? The bond market is looking like a crisis event is coming. I don't know. I don't know if that makes sense to me. Octavius. Like, the bond market is looking like that something is about to break, and that could cause a problem in the market, but not like it's like they're pricing in a price. You get what I mean? Okay, but going back to the spreadsheet here, you guys you're trying to get me off track here. I can only focus this one thing at a time, and my short-term memory is not, I'm not very good at holding a bunch of numbers in my head. So you said, so there are TN price is 119.875. You're saying we wanted to adjust that price with what we would have to pay for the 3 months. Oh, you know what? I did it plus, but really it should be minus, right? 0.0376. Okay. But then that difference between the 6, so it's 0376 or 3.760, right? If we just say right now that the 10-year is 3.7, that means that the basis difference between the future is 6 basis points. Is that correct? So then if I come here to the Treasury Analytics and I look at the 10-year, Ultra 10-year, basis net of carry is 1.7. Is that right? Is that right? And it's good that the basis is net of carry. Actually, it's not good basis net of carry because we already got that. Sure, but yeah, we are kind of spitballing it. But basically, what I'm asking is, okay, this calculated YTM plus basis net of carry should equal, and then you would get the yield, the futures yield, which is like 3.724 or whatever it is, right? Right? But we calculated the basis of the carry. So we're saying that the basis that's added on top of the carry is 6 basis points. Is that right? But basically, you're saying this yield that we've calculated here, once we have this adjusted price, is what the interest rate should be for the instrument, right? On the delivery day, yes. Okay. I guess I was kind of trying to take it to the point of, okay, so what should the rate actually be now, right? But this is where it gets funky because, like you're pointing out, the micro treasury yield futures, they expire at the end of the month. So if I want to know what is the appropriate micro treasury yield future over here, right? Well, then I'd have to convert between like ZN, TN, or whatever, and the correct ending point. And I know that there's math you can do to figure that out, but when I was looking at it, it was like the degree of accuracy was not within a basis point, essentially. So you couldn't use it to try and like arbitrage over here. Whoa, is there no? Well, so this is cool. Let's save this. I think that we did enough for today. We can do more on this spreadsheet another day. Yeah. Maybe we can try doing that calculation. Let's save that. This all came from a question in chat, though. The answer is that it's really complicated. Right. There are ways to calculate it, but it's kind of complicated. And to get the degree of accuracy that you, to do what I think you want to do, because you didn't really say why, but I'm assuming you're doing it because you think there might be some sort of arbitrage opportunity. My point is that information alone isn't enough to get you accurate enough to arbitrage it. But you know, I don't know. These people that are putting liquidity here on the inside, I don't think that they're doing arbitrage. You know, they've got other stuff going on to just be competitive. Yeah, the answer is that for speculatively buying and selling, it's not worth it. Yeah, it would only make sense to be doing those calculations for an arbitrage or a market making thing, right? Jermax, if you want to send me a picture, you should send it to me on Discord. You have Discord? Well, I think it was like 3.68 where I was thinking maybe I would go in again, and it hasn't actually moved that much from there, even though they did kind of go a little bit lower. So I bet you probably could hold it to some point, but now, interestingly enough, the 30-year retraced itself all the way back in cumulative delta. The selling was very much so primarily coming from the 10-year treasuries. Another thing you can do, Jermax, is you can just put spaces around the periods. Just don't put the whole URL in. I'm smart enough to figure out what the rest of the URL was. Like, just don't put the .com bit on. Or just give me the imgur, the ID bit that comes at the very end, because I can just go imgur.com / and then. So yeah, you'll keep getting slight variation because TN gets traded with 9.5 years, and on top of that, you have compounded 3-month rate. Those do add up. So if you use flat 10 years, you are already a bit off, right? Like, or to put it another, geez, this is another new low. Like, holy crap, dude! This is I do think I've seen a move like this before, but it's been so long I don't remember it. This has just been relentless. I'm really caught off guard and surprised today. I'm glad that I stopped trading after 2 or 3 or whatever. It was net $40, and I actually was gonna make some of it back, but then I took that off. That first one was a good trade too. That's kind of the funny thing, is that in the beginning it was rolling the way that I thought. Then it kind of turned down. The volume wasn't enough for me to be sure, but then I took the second one, and then after the second one, then it was for sure like, okay, what the hell? right? But then it just keeps going down and down and down and down and down. And we're not really sure what the driver is, right? There's no news. I don't believe personally that there's anything in what we saw from the Federal Reserve yesterday that justifies selling like that. So I really think that a really big entity like a sovereign bank came in and sold treasuries. They had big holdings or something and they wanted to dump them. That's why I said that day micro yield futures are stupid. They should just make micro treasury futures with a FV of 10K or something. Well, I disagree. I disagree. Well, because I think that you're taking it from the perspective of, well, how do you hedge it, right? When you trade the treasuries over here, you're thinking, okay, I can have like a full treasury and I, can sell the future, hold the treasury and then deliver it and make money on the basis, right? And because this follows that, this is what that was designed to be for, right? You can make a consistent stream of income, although you'd have to have a lot of money to begin with, and the amount that you'd be making wouldn't be very much. But the bank, that's what the banks do. And it all adds up, right? So from that perspective, yeah, you can't do that in the micro yield futures. You can't. But I think that they're taking it from the perspective of, one, we want to give people an instrument where so it's cash settled, right? So that's the first thing, is the micro yield futures are cash settled anyways. So it's designed more to just give you direct exposure to the interest rate in a way that the regular treasury futures don't. So their goal is good. Their goal is good, and the sizing of it was really smart too, because retail traders can come in and scalp this and only risk a little bit, right? And bigger players will still find these useful for swing trades. Not like really, really big traders, but a little bit of a larger account. They can still find this useful for hedging. Like if you have $100,000 portfolio, you can come in and take a couple of micro treasuries and hedge yourself, right? And there is enough here that, these market makers in the micro treasury yield futures are making money. So I think it works. It's just the issue is that everybody wants to trade the 10-year and 10-year and the 2-year and not the 5. So much so that apparently nobody's even putting out offers now in the 5-year, which is pretty wild, right? And like no trade out there. So they have a problem. And how do you get more liquidity out there if you don't have an instrument to hedge against? Well, you don't need to in the 10-year because people want to trade and market make it anyways. But what do you do about the 5-year? And I'm kind of thinking maybe they just get rid of the 5-year. They keep the 2, the 10, and the 30. Maybe. But I wouldn't say that they're stupid, right? Because they do fill a market need. And another thing that I think is really important here is that benchmark rates are not very good in the market. You would think with the treasury market being so large that the benchmark rates would be like really, 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 really set. But the reality is that what is the current 10-year yield is actually kind of a fuzzy thing. Like anytime that you see somebody on Twitter, like a news like CNBC or whatever saying 10-year yields move to this, you don't actually know which one it is. It's like, okay, so is that the on the run on the CME's exchange. What do we call it again? Or you know, there's like different exchanges, and those are going to be slightly different. And like, which one actually is it? And there's like all of these complications to it because there's, you know, there's different QSIPs and they're all worth some. Broker Tech, that's right, yeah. So I clearly taking those two losers, sorry, three. I think of it as two $20 losses, but it was three. Taking those three losses really messed my head up. Is that the word? I wasn't like, well, so I was feeling really stressed out, but I think that it's just like the chemicals when you get into a losing state, you know? So that makes it really hard for me to sit here and do all the math. And on top of that, you're trying to show me to do something that I don't really know very well. Never done before, don't really understand very well. Oh man, did my camera die? I guess I didn't. It didn't get charged overnight? That's kind of weird. Or did it overheat? That doesn't seem right. Yeah, it's not showing me anything on the screen, so it must be dead. Anyways, for our purposes, they're great. Obviously, it would be better if I had $100,000 and I just buy a bond and sell it. Although at that point, why don't you just sell it? You know, have $10,000, sell a ZN contract, right? You've made like 7-8K this year off of it. You know. Oh my gosh, it's a terrible frame for it to stop on. Oh my gosh, I've gone like way overtime too. I should go and add another one of these little lines in here to be like, this is when you need to stop, Seth. All right, well, you know what, guys? I guess I will get going then. That sucks, but we're probably going to have plenty of opportunities next few weeks, so don't need to worry about it too bad. I will see you guys tomorrow. In the meantime, stay excellent.